All right, good morning. Today is November 15th, Tuesday. We were supposed to send this out yesterday, but our systems were not working, so we got those fixed. So, what we have coming up this week, today they have PPI coming out, so that will probably affect the markets a little bit. I think most of it that we saw kind of immediately were, with CPI last week. You've got some Fed speakers talking today. Real household debt, real mortgage debt. We already know how that's going to come in. Then tomorrow you've got retail sales. Um, Something with House Financial Services Committee. Initial jobless claims on Thursday, continuing jobless claims, building permits, housing starts. So that's going to give us, the initial jobless claims is going to say, hey, the rates are going to go up in December by 50 or 75. I think right now a lot of people are thinking 50, but we'll see how that comes in. And we'll go over the 10-year on this video too. Building permits, and keep in mind this is all, and then Friday you've got existing home sales. Keep in mind that all of that is on a national level. Obviously, we're covering more local stuff. As far as the 10-year goes, I pulled it up, and you can kind of see, I think I've got what, October 4th, they were down here at like 3.5, right? So that puts your mortgage at like 6.5, something like that. Today there, but back then, right? I say back then, it was like a month ago, right? That was a great day to lock in a rate. Um, and then now, we talk about like not timing the market. Buyers that locked in like Thursday of last week, Thursday, Friday, I mean, and even now compared to, November 8th, um, got a really good deal, especially if they were able to get like builder incentives or seller incentives, whatever they're looking for. They're at like 6, 7. They're under 7%, depending on their credit, but just generally on a 30-year, which is pretty good. Um, you can see the chart that I use for like day trading and stuff like that, but I don't think you can look at the 10-year the same way that you look at everything else. But if you were, you can look at some of the other, momentum indicators as far as where it's going. Um, as far as the pricing trend, so I think last week talked about putting all of our MLS into the data instead of just the three counties because it affects the numbers, and you're going to see how that happens right now. So um, from a week ending, last week, we're at a median price of 332, call it 333, which is down 14% from that May high at 381. And then from a week standpoint, it's negative 6%, a 6% drop, but year over year, it's still up 7.4%. The crazy part about this is that even though, and I've said this multiple times, but even though you've got a, 14% drop from this year's highs, you're still looking at year over year gains. We were expecting about a 10%. When I say we, I was expecting about a 10% drop from this year's highs to end the year. And right now we're looking at 14%. But I'm going to show you why that's kind of wrong. Again, I like the monthly data better than the weekly. This kind of just gives us a pulse on what's happening like this week. And I'll be able to show you more about what's happening this week or last week for that matter. Um, so my 10% number from a monthly standpoint still doesn't work. We were down almost 6%, and then I was expecting to hit 10% in December, and then prices went up last month. And it's because of the same thing we keep talking about. The inventory that people think is out there isn't. Most of the inventory that's out there isn't really good. If you're an agent and you're previewing properties, there's not great stuff. The best inventory available is kind of new construction. Everything else kind of seems like the scraps of what people didn't want, or what some flippers are like trying to get rid of. And they kind of overdid it, and not in a bad way. I mean, they had to cut corners because middle of summer, everything was super expensive, inflation, labor, materials, literally everything. And that's where the PPI report kind of comes in, because we're saying, hey, our producers, has the tightening on prices caught up to the cost of making those goods, right? So that's what we're going to find out today in 2 minutes, actually, while I'm recording this. All right, so sales price, closed sales. So this number is way down. Keep in mind, we did have a hurricane last week, so if people couldn't bind insurance on existing properties, they weren't able to close. I'm not concerned about this number. I do believe it's going to go up after we get this week's data. Hurricanes always mess us up. Now, should it have been in the 400s? I think so. At 236, that's a lot of properties that didn't close. Let's see where we land by the end of next week. Now, because so few houses closed last week, that's going to easily sway all these numbers, right? So that's, just keep that in mind. Everything, as far as sales price, as far as, sold price per square foot, all of it. So, yep, sold price per square foot for our entire MLS is at 201. Let's look at days on market. All right, so our days on market went down for our MLS 13% to 46 days. Remember, I keep talking about the fact that there's not the real inventory, right? So even I'll go to new listings. So new listings dropped 14% week over week, and then compared to October 15th, look at that. It's almost half, right? It's more than 40%, more than 30% drop in new listings. Why is that happening? So think about cost of money from a homeowner standpoint, and then think of cost of money from a builder standpoint. Existing inventory doesn't so much matter to me right now, because I think some of the best existing inventory is locked up with sub 5% mortgages. Why would they ever sell? It makes no sense for them to sell. We tell our customers that if it's a primary residence under 5%, they don't need to sell it. Luckily, we have an advantage with having new construction inventory, so we're not hounding you trying to get your listing, right? If you have a secondary property and the costs of it have gotten too high, then it kind of makes sense to cash that in and maybe take advantage of some dips in some other markets, whether it's real estate markets or other asset types. And so you see the new listings number coming down. That's partially because of two things. People are realizing it doesn't make sense for them to sell, right? Because we've been saying that for months. And then builders are also, with our builders, they have told us, hey, we're going to build a little bit slower right now because there's no sense in building all these houses and then paying these high interest rates on this stuff if it begins to sit. We'll basically build it as they sell. So the people that want to come in to move in ready stuff, it's going to be harder for them to do that. But they don't really have a choice because, again, your good inventory isn't there. And so here's the thing. Are other builders sitting on inventory? Maybe. From our new construction standpoint, all of our stuff is in the entry-level market. So we're $300,000. So not only do we have the hedge funds that want to buy our inventory, but we're the most affordable building product in our market. So we don't have any models available to show. If that's not a very telling sign, I don't know what is. We don't have a completed house because as soon as they complete, they've already been tied up by someone who's closing. And we saw some of those closings happen last week in the middle of a hurricane because they got lucky with their insurance. And they got pretty awesome rates, and they got some buy downs. So they're paying what they're getting more incentives than people who bought in like February or March. And they're getting a better rate or a comparable rate in year one. And if those rates do keep going down, they're going to have an advantage when they go to refi. It's just crazy how the timing works for everybody, but it is what it is. Let's go to percent of cash sales. So that went up to 30.5%. Again, remember the hedge funds we're talking to are all saying come back in, come talk to us in January. Well, we just got an email last week that said, hey, here's our new criteria for yields and this is what we want. So they're saying, hey, come back in January. But again, if you're looking to get into the market and you're an individual investor, not an institution, consider December. Make sure you're underwriting to rents and not Airbnb values. A lot of those people are getting burned right now. I don't mind saying we kind of told you so, but that's the business that they're in. And let me go to distressed units. It's still less than 1%. The Crash Bros talking about markets crashing because of COVID, whatever, pushing off mortgages. None of that matters. There's so little inventory for distress. It's crazy. It's negligible, and the auctions don't have much of that either. If you do need retail help, I obviously would love for you to use our team, our retail team. We can also help you with auction bidding. If you have a cash account in there, again, stemming from this distress number, there's not a lot of it there. So you can bid on maybe, 20 a week and maybe get one if somebody doesn't overpay. The hedge funds are still buying at the auction. And for me, that's a telling sign as far as, hey, are they active or not active? And they're still buying. So let's take a look at our percentage of closed above list price on a weekly. Okay, 13% of homes. Sorry, I was thinking percentage of list price, but this is 13% of homes closed over list price. And that number, eked up. Again, take the good with the bad based on the data you have. I see a downward trend and then kind of a leveling off. That's all I'm looking at. I'm not really looking at the number until we look at the monthlies again. So I hope that was helpful. If you found this valuable, please like it, share it, enjoy it, and we'll see you next week.